Why did US inflation get so high this year, and where is it going to be in 2023? Those are the questions I will try to answer. That is the reality. Prices for everyday consumer goods continue to rise, even if inflation is showing signs of slowing down. Inflation soared in 2022 because of COVID-19, the war in Ukraine, and a broken supply chain. In an article that I posted yesterday, I reminded everybody that just a few years ago, inflation was not an issue anymore. Actually, in 2019, magazines like Business Week were asking, is inflation dead? And then came COVID-19. Supply chain issues, sickness, death, and the war in Ukraine disrupted the global trade. Fueled up by government handouts and savings, consumers bounced back from the pandemic shutdowns with a lot of cash on hand and a burning desire to buy. But the only thing in the shelves were a short supply of everything from used car to lumber to housing. Yep, and because of supply and demand, when there is a shortage of products, price soar. That triggered a cost of living crisis unseen in a generation. In 2022, US inflation reached a 40-year high. Now, there are some signs that the price increases will slow in the coming year, but the overall picture is still very complicated. Here's some insights about inflation this year and where it is heading. Question: why did we get so much inflation this year? Inflation started at 7.5% in January 2022 and eventually climbed up to 9.1% in June, with gas prices reaching $5 a gallon in some states. The inflation rate for gas prices alone was 60% at the time, and largely because of repercussions from Russia's invasion of Ukraine. Rising oil prices and lingering COVID-19 supply chain issues kept food prices elevated. A shortage on semiconductor chips continued into the first half of 2022, keeping new and used cars prices very high. And the labor market has been very tight for the whole year. Even when inflation started coming down from its peak in June, core inflation, which is the price of all goods and services, went up in September to 6.6%, showing just how widespread inflation was. The last few months have finally seen inflation coming down at rates lower than economists had expected. In November, good news, inflation was at 7.1%, the lowest rate of the year. Question: did economists expect inflation to get this high in 2022? Well, not exactly. Many economists, including those at the Fed, believe that inflation would be transitory or temporary. They thought it would quickly ease in 2022 since supply chains issue got resolved at the end of 2021 and people slowed their spending. A transitory inflation was the message that both Joe Biden and Fed Chair Jerome Powell were broadcasting at the end of 2021. Instead, the supply chain issue continued, particularly because the Omicron variant emerged and proved difficult to control, especially in China. Then Russia invaded Ukraine at the end of February, causing massive disruptions to the global supply chain, particularly in the energy market. And of course, unemployment was the lowest in generation. And even amid continued rising prices, US consumers continued to spend, showing that repressed feelings about the COVID pandemic demand was larger than expected. Now, more demand amid more shortages, a tight labor market, lead to rises in prices. And again, that's just the law of supply and demand. So question: what has the Fed Reserve done to address inflation? Well, okay, the main tool the Fed Reserve has to address inflation is to adjust interest rates, which is meant to tone down spending by making borrowing money more expensive. Now, if money is more expensive, consumer buy less. Less demand lead to falling prices. Again, supply and demand. Starting in March, the Fed started rising interest rates at a very aggressive rate. In December, the Fed raised interest rates for the seventh time this year, raising interest rates from 4.25 to 4.5%. Some few economists said the interest rates have only played a small role so far in getting the inflation rate down. That's because the interest rates have been mostly felt in the housing market since rates directly impact mortgages. Indeed, home sales have been falling since February. Truth is that it takes a lot of time to curb inflation. What has taken years to do can't be undone in weeks or even months. The interest rates rise played a little bit of role, but the bulk of the Fed's tightening is going to be felt until next year or even to some extent in 2024. So question, will inflation continue to come down in 2023? Well, Fed Chair Jerome Powell is taking a pessimistic view on inflation in coming year. He said, we have continually expected to make faster progress on inflation than we have ultimately. The Fed has indicated it intends to keep rising rates until it hits somewhere around 5% to 5.5%. Whoa, and that's a sign that inflation is stubborn, not transitory. But compared to where things were last year, things appear to be on a better place this year. The things that looked like they were getting better this time last year didn't get better, they got worse. But this year, things are getting notably better. And the better is coming from several directions instead of one. I know, that said, it feels like there are more cause to be optimistic. And here are the good news. COVID-19 appears to be more contained now than it was this time last year when the Omicron variant started spreading. Supply chain issues are easing up, leading to, for example, new and used car prices dropping. And the US has adjusted to the shock to the energy market caused by Russia's invasion of Ukraine. Gasoline prices has been getting down for the past 6 months. But believe me, it's going to be messy. It's going to be a wild ride. That's why it's mostly be resolved at the end of 2023. Well, unless something else bad happens in the world, 2023 is a path back to something that's going to look normal. Question, what about employment in 2023? Well, the Fed has actually a dual mandate. First, keeping prices stable, and second, maximize employment. Right now, the Fed is focused on getting inflation back down to its target of 2%. Coming from 7.1%, there's still a lot of work to do. And the biggest victim of that policy is likely to be its second mandate, keeping people at work. The US unemployment rate fell in November, and many companies are still reporting having difficulties finding people to fill open positions. So far, the job markets have shrugged off inflation and the Fed's rate hikes. While price pressure have been high, the unemployment rate at 3.7% in November is around the same rate that it was before the pandemic. And don't get fooled, that is a record low. We haven't seen that low record of unemployment in decades. The problem is that as the Fed continues to increase interest rates, unemployment will rise. The Fed is projecting unemployment will rise to 4.6% next year. Other estimates, like the one from Wells Fargo, have the unemployment peak closer to 5.5%. The Fed has not raised rates this aggressively in decades, and it takes time for those increases to work their way into the real economy. Right now, it is too early to predict how many people will lose their job. The only certainty is that some people will lose their job due to the Fed's decision. That is a certainty. How many jobs will be lost depends on how the economy responds to the Fed's continued interest rate hikes. And yes, the Fed raised interest rates again this month. Granted, it was by a smaller percentage than its last 4 hikes. Still, critics charge the Fed has done too much too soon. The shadow of inflation may be disappearing, but it looks like the transitory inflationary period will last well into 2023 and maybe beyond. So, buckle up. In 2023, the road will be bumpy.